there was a ton of money out there and being raised and being deployed at, again, 3.5 cap rates. And look at where we are now. We're at 5 to 6% cap rates. And it's a lot more difficult to raise money now at much more attractive valuations than it was when times were going well on the real estate side.
Welcome to The Real Deal, a commercial real estate investing podcast. I'm your host, Aman. There's a ton going on in the world right now, and much of it impacts real estate investors. The Real Deal podcast will take a look at what's happening and how it influences you as a real estate investor. Each episode is a 20-minute segment dedicated to distilling the day's most important news, so you can stay up to date on what's going on in the world and how it might affect the commercial real estate market.
Welcome back to another episode of the Cashflow Capitalist Show. Today we have Evan Curtis. Hey Evan, welcome to the show.
Hi, Aman. Thanks for having me. Excited to be here.
So introduce yourself in like 30 seconds. Tell us who you are.
Yeah, I'm a seasoned real estate and finance professional. Have about 18 years of experience kind of across the two fields. Started out in with a very large investment management company called PIMCO for about 12 years. Focused on fixed income and private equity real estate related products there, and also went to a much smaller value add multifamily shop after leaving PIMCO, and was there for about 5 years, and more recently joined a company called Vanamor, and we are in that same space of multifamily value add investments that we are acquiring in targeted locations to produce attractive cash flow and long-term capital gains.
So when you were working at PIMCO, what was your role? Were you like more focused on acquisition or you were in operations? What were you doing there?
Sure. My role on the real estate products that we were working on, I was in what was called the product team. So my role was to help raise funds for the private equity funds that we were raising, and to effectively act as a pseudo portfolio manager to assist with the client servicing aspect that teams had. So we were the team that put together the marketing decks and really understood the trades that were happening within the portfolio. And worked very closely with the portfolio managers who were kind of executing those trades.
Mm. So if I ask you what kind of experience and knowledge that you're bringing from private equity into your current company that can help you scale faster?
Yeah, I think one of the biggest things that myself and the whole Vanamor team brings is we all have kind of this institutional background that is really helpful from an understanding of the macro picture that's happening. We like to take a top down view combined with kind of the bottom up property level fundamentals view, and getting training and working with the quality of folks that we and I worked with at PIMCO over the years, I think has been invaluable to kind of understand how cycles move and being able to put kind of context into where we are within those cycles and understanding relative value. So a good understanding of capital markets, I think, can be an underappreciated skill that not everyone without kind of a finance background can have. So I think that's definitely one of the things.
And if you talk about capital raising, what kind of investor avatar are you targeting the most? Because I know you live in Long Beach. Like in LA, there are like so many big family offices live there too. What kind of avatar are you targeting the most, and how are you doing it?
Yeah, it's a good question. It's a diverse kind of I guess, channel approach that we have at Vanamor. So our current portfolio is roughly 100 million in size, and we have raised that over a number of different deals over the years, and we're using the single asset syndication model. So when we find a property that fits our buy box, we go out and raise equity to invest alongside of us. And historically, the majority of our investors have been kind of high net worth individuals, and kind of expanded friends and family network. So, that's our core investor, but we also have relationships with kind of family offices, smaller RIAs, and other groups that can be more of a programmatic joint venture partner. So we're definitely exploring and speaking to kind of both channels. But I would say having a lot of conversations with kind of the high net worth individual who is interested in real estate, maybe has a heavy allocation of public equities in their portfolio currently, and just wants to understand and learn more about how private equity investment into real estate can diversify and be a very positive, tax efficient asset to their portfolio.
Hmm. And your business model is same as syndication, or you bringing any kind of like institutional business model into your syndication as well?
We're so our buy box is, we're focusing on middle market value add multifamily. So we define middle market as kind of the $5 million to $50 million space. And, the institutions generally are a little bit above that space. So we're in what we like to think of as a less competitive space. So, we are bringing, again, kind of a team with institutional background to a space that's a little bit less competitive and isn't full of groups with the same institutional background. So, we like to employ very what we think are scalable options to a space that doesn't necessarily have as much of that currently.
And don't you think even if you're targeting 5 to 50 million, you will get different kind of competition in that too? You might not get the institutional competition, but other kind of like mostly syndicators who also targeting the same places.
Yeah, it's less competition, I'll say, but definitely still a good amount of competition. I mean, at different points in the cycle, actually, you might argue that there's more competition in the certain space, because, like where we are right now in the cycle is you're seeing a lot of institutions that have pulled back and are kind of on hold. They either, the going in cap rate combined with where the cost of debt is doesn't make sense, and they're kind of just pulling back. Whereas we've seen, still some fairly aggressive smaller acquisitions being completed from groups that, they're able to still raise capital at what are pretty aggressive terms. So, there's definitely competition, and especially when you're talking about an asset that's 30 to 50 million, you certainly are in the space of when institutions would be looking at it. So I gave a very wide range, 5 million to 50 million. $5 million asset, you're not going to get any institutions looking at it. This doesn't make sense. So, you can be acquiring from kind of the mom and pop owner who's owned something for 10 years. When you're in the $5 to $15 million space, they've just kind of ridden the appreciation wave up over the years. And that's definitely a different profile than the 30 to $50 million size.
And what's your opinion about right now? There's so many big institutions. They're just buying single family. I read about it. This 7 out of 10, maybe like 1 out of 4. I kind of confused about that. House is owned by some sort of institution like BlackRock and Blackstone, Vanguard. So, what's your opinion on that?
I've read some, and I've seen some conflicting data on the number of single family homes that are owned by kind of the institutional single family rental managers. And from what I've seen, it's relatively low compared to the total kind of outstanding supply. But, I think from an asset attractiveness perspective, I like the single family side. There's been this perpetual undersupply of new development on the single family side that has created, pretty good supply demand dynamics. And, you've really seen prices reflect that over the last couple of years, and the pricing moving up what it has moved up. And I think you get, some of these groups have taken a little bit more heat for being buyers of those assets than what may be actually true as far as their total demand for what they're acquiring out there. But I think one of the challenges on the single family side is when from an operations perspective is, you're managing disperse asset, a portfolio of dispersed assets. So it's not, an apartment building with 100 units at it. It's 100 units is pretty hard to get concentrated in one area. So you have some economies of scale issues that you have to figure out. And, when we're talking about the really large shops, they can figure it out. And a lot of people have been able to figure it out. But I think that's definitely one challenge that comes to my mind as far as the single family rental space versus the multifamily.
Mm, yeah. So as an institutional, as an institutional investor person, if I ask you, why are they focusing on single family? Because people like you and me, if you want to scale, we are talking about multifamily syndication. Why big institutions are targeting the single family right now?
I think a big piece is the supply dynamic. Home builders are not generally building the entry level housing. It just doesn't make economic sense to them. So, what is being built is a lot of times it's more of the higher middle to higher end type of home. So, the folks, all else equal, they prefer to live in a single family home versus an apartment home. So, you have desirability of that asset class combined with lower new supply and historical supply of that asset class. And, I think it makes sense if the pricing and the valuations align, but I think it's gotten difficult. And, you've got home ownership and just affordability gap between renting and owning at the widest margin that it's ever been. So, you likely will continue to see a lot of folks that are going to need to continue to rent, and, they want to rent a home. So, you have a pretty low vacancy rate on the single family side as well.
Do you think if all these big institutions keep buying single families and they will create the monopoly in the market of single family and they can control the prices the way they want it?
I don't think so, because I think the statistics are. I think you're getting a lot more headline statistics that are, again, overemphasizing the total amount of single family homes that are owned by institutions versus just single family owners. So I don't see anytime in the near term, at least, a really meaningful impact driven by institutions. I think you could actually see the other thing. You could see things potentially move the other way. You could see these institutions looking to offload some of these single family homes, especially the ones that have been buying them up for the last 10 years and probably have a really low basis. Like, one of the other problems with the single family home side and the way that people underwrite deals is, yeah, your cash flow looks okay, but when you have to put on a new roof, like, all of a sudden that $30,000 expense really hits you hard on a single family on the single family side. So maybe it makes sense to sell the asset at that point, and, maybe you get, BlackRock and some of these other groups offloading some of this stuff because their basis is so low and they want to roll it into a different type of property.
And I was reading that yesterday. Congress is also working on bringing out a bill to stop hedge funds to buy single families. And if whatever they bought it, they have to offload in the next 10 years if that bill passed. So,
Some of the
what's your opinion on
some,
that?
I think there's just a lot of politics going on
Yeah.
there. Again, I think it's a lot of headlines that, the average reader may not know the real statistics, and that headline, though, looks really good from their reelection perspective to say, hey, I'm fighting hard for the rights of the owners, when in reality that's really a very minimal or marginal impact to the total stock of housing.
Yeah. And it's all about the lobbyists who are sitting behind and just paying, I don't know, heck lot of money to politicians to bring in their bill up.
Yep.
A- And if I ask you, so what kind of markets are you targeting right now, like in today's economy, and what's your approach behind it?
Yeah, so we cast a fairly wide net as far as markets and geographies that we're targeting. So, we look at it as kind of an L shape on the West Coast. So from the Pacific Northwest down to California and across the Sun Belt, to Texas, and plus Florida, because we've been kind of covering that market and own an asset out there in our current portfolio. So, generally we like markets that are exhibiting strong population and job growth. So Sunbelt makes a lot of sense there. There's a lot of challenges, I think, in the current market that are interesting from those folks looking to acquire right now, but maybe stressful or making people lose sleep at night for people who bought very aggressively over the last couple of years. Like there's a lot of new supply that's coming online in Sunbelt states. And that is having an impact on rental growth rates. You're actually seeing rent declines across a number of markets. Combine that with a very elevated cost of debt today versus where it was in 2020, 2021, early 2022. So there's definitely stress that we're seeing in markets that we're covering, but I think it makes for potentially a very good opportunity over the next 18 months to be deploying capital and building a diverse real estate portfolio at a reasonable basis in areas that are positioned for long-term growth.
And many people are also like thinking about there's a lot of risk and reward. And how are you managing that in today's economy? If you even start buying today, and even if you go to Sunbelt State, what kind of risk and rewards are you like? Keep that in mind when you have to invest in some sort of like new property.
Yeah, good question. I mean, at Vanamor, we like to describe our strategy as a company that uses very conservative and realistic underwriting metrics, and the risk reward just was tough prior to the Fed pivot. I mean, you saw properties and transactions getting completed at 3 cap, 3.5, low 4% cap rates. Debt was extremely cheap at that point in time, so you still had positive financial leverage, but growth assumptions were very aggressive as well at that time in order to make things make sense. And things have slowly but surely moved quite a bit at this point as far as where going in cap rates are and kind of the overall risk return perspective. So, we're looking at deals, and we recently just closed on our first and only deal in 2023, which has a going in six cap with seller financing at 5% fixed for a 5-year term, in a market that we think is poised for steady growth with limited to no new supply, and 1997 vintage. And it's a great profile of a value add asset that we think has a very favorable risk reward profile, where we're generally not, we're not underwriting to hit a home run, but singles and doubles are right in our kind of wheelhouse. And I think it's a very important piece to understand, because where a lot of people get tripped up that aren't in the industry and may not fully understand is you can really tweak an underwriting model or just a financial model in general to show very strong returns, but the realistic ability to hit those returns is another thing. And if you can't kind of pick it apart, you can very quickly be in a situation where you not only miss returns, but you could be potentially losing money. So I think the overall environment from a risk return perspective at going in 5 to 6% cap rates looks a heck of a lot better than the previous environment that we were in. And that's one of the big reasons why we're excited about potential opportunity coming up here.
And you also mentioned about your markets are in California. And I have seen all the deals like max to max 4.5 cap rate. Even if you have an interest at 6%, getting a 4.54 cap rate, that does not make sense. And you literally like getting a negative cash flow. And how are you penciling out those deals?
We're generally pass on those deals. So, I get exactly what you're saying. I mean, I could try and play devil's advocate and say, well, who is buying that deal? There are certain buyers, especially when you're talking about California or Southern California, where you're very constrained as far as new supply. So you don't have some of the same risks that you have in other areas. You just have this, you have the weather in California that leads to just ongoing demand and more aggressiveness compared to other areas. But it's really hard to make a deal pencil if you have a 4.5% going in cap and 6+% debt. No question. So, would we be looking at deals like that? It's good to underwrite them and know where the market is, but very unlikely that a deal like that would make it far at all, kind of in our review process.
Who are those people who are buying those deals? Because somebody else is buying it. Which private equity companies are buying? Because I don't think so. That's easy for any syndication company to come and buy in California and still be managing and still be like giving 15-18% return to their investors, which is slim to nothing.
Yeah, it's, again, I think, good question. And the composition of the total return, I think, is another area that is not that shouldn't be underappreciated or understated. So you can get to a 15% total return on potentially this negative leverage scenario where you're talking about 4.5% cap rate, 6% debt. But the only way that you're going to get there is if you can capture a huge rent premium from where in-place rents are. Because your ongoing cash flow on a property profile like that is going to be negative to 1-2%. Like you're going to have almost nothing as far as cash flow. So if your whole 15% total return in that scenario is dependent on you exiting at a defined cap rate that you're modeling to, and being able to capture very large rent premiums, and like who are buying those deals. There's some strategies that I'm seeing where you have a very low in place cap rate, but you have people who are 50% below kind of where market rent is, and it's clear they really are 50% below market rent, but that is because there's rent control in California that makes it very difficult for an owner to catch up to where market rent is if they haven't been doing so over the years. So, some strategies that I've seen are you have a very large budget for cash for keys. So basically you're going to offer somebody $35,000 to help them relocate to another unit, and that will ultimately let them vacate that unit, and then you can get in there and renovate and fix it up and capture this huge rent premium. So you could have a stabilized cap rate that is significantly higher than you're going in at 4 to 4.5 in that scenario, and maybe it makes sense, but there's a lot of moving parts in that strategy in my mind. Although I know some people are executing it effectively.
Do you think that doesn't even make sense that you have to pay your tenant to leave your property, like 30-40,000?
It's one of the
Give me a political answer.
yeah, right. It's one of the externalities of rent control. I mean, that's one of the big reasons why California is tough. Like you can't get to that loss to lease that is in these properties unless you have a way for tenants to voluntarily move out. And the only way that they're voluntarily willing to move out a lot of times is to give them a very large incentive to do so.
Wow. And if I ask you, what mistakes have you done in the past, and what have you learned from it that you are focusing on that you're implementing in your business now? If you just have to share one mistake that you wouldn't do that again.
Yeah, I think underestimating the time that things can take to play out on kind of the stress situation. So again, heading into 2023, interest rates were already up to roughly to where they are today, from the Federal Reserve interest hiking interest rates perspective, and the thought was that was going to cause a lot of distress and opportunities, therefore, for buyers. But the timing of that stuff is certainly, I think, was a miss from my perspective on when that would happen and how long that process can take. Which, I started my career in 2005, so I kind of saw the final stages of the run up in the housing market prior to the ultimate crash in 2008. And um, I think 2008, there was a pretty long down period. Even though things happened quickly, there was still this very multi-year kind of down period, and really properties moving through the financial system, foreclosure, resale, and things. So I think that's definitely a miss and a mistake on my end is not appreciating the time that some of these things take to actually happen.
And I've seen many syndicators get into real estate in the recession. Many became investors in the recession. They were like, we want to invest, we want to learn. I think um, recession has the most opportunities to invest. What do you think about that?
I agree. I agree with that. I think so. At my previous company, there was a saying from the founder. He said, generally, you're in two markets within real estate. You're in, and it's easy to buy and hard to sell, or it's hard to buy and easy to sell. And when you're in a recession, it is easy to buy from an underwriting perspective. Like the numbers seem to make sense. Your cost basis looks good. Long term, you're like, I think this is a fantastic asset. And you know, the tricky part and the challenging part is there's so much psychology in investing. People are very hesitant to invest when markets are down and there's blood in the water and there's pain out there. And so having the equity to deploy when you get to these recession times is one of the key things. And that's very true now. There was a ton of money out there and being raised and being deployed at, again, 3.5 cap rates. And look at where we are now. We're at 5 to 6% cap rates. And it's a lot more difficult to raise money now at much more attractive valuations than it was when times were going well on the real estate side. So,
Yeah.
yeah.
Yeah. And what advice do you want to give to somebody else who's just getting new into real estate, who wants to get into real estate? What advice would you say there?
There's a lot of education out there, through podcasts, through reaching out directly to folks like myself. One of the things that I offer out openly is feel free to reach out. I'm happy to chat. I'm a real estate guy and a real estate junkie. Like I just enjoy talking about this stuff and happy to kind of share things that I've learned over the years. And my advice though is now is the time to focus. To your point of your last question, in times of recession are when you want to be buying and acquiring assets for a long-term hold. So, very interesting market right now. We have real estate valuations on the multifamily side down from peak pricing anywhere between 15 and 40%. Yet you have public equity markets at or close to all-time highs. So you have this very big gap in what's happening in the public equity markets versus the private real estate side. But I think now is absolutely the time that people who have wanted to invest and are interested in investing should really kind of get dialed in and start following it more closely.
Got it. And before we wrap this up, I have one more question. If today is the last day on this planet, what's the one thing that you want to do? What's the one last wish?
Well, I've got 2 young kids and a wife, so it would just be to play with my kids because that's their favorite things to do. They're young again, so they like to throw the ball, play tag, do things like that. So that would be my final thing.
Nice. And if somebody wants to reach out to you, where can they reach out to you?
Yeah, they can find me on LinkedIn. Just type in my name, Evan Curtis. You should see my profile. You can also find our company, Vanamor. That's VANAMOR.com. So you can find my contact information on the Vanamor website and sign up. We put out a monthly newsletter that kind of just talks about market events and trends that we're seeing. And if you're an interested investor who is an accredited investor, you can also sign up for our deal list, where you'll see opportunities when we do have them. So again, feel free to reach out if you just want to chat as well. So happy to talk.
And I'll make sure I put all the details in the show notes.
Great.
And all right, thank you so much, Evan. Thank you for your time, and thank you for sharing your knowledge and wisdom. And I'll see you another one.
Thank you for joining us on The Real Deal, a commercial real estate investing podcast, the show that covers everything to do with multifamily real estate investing to help you become an expert in your real estate ventures. We're here to help you create passive income and financial freedom so that you can achieve what you want whenever you want. We'll catch you next time on The Real Deal.